So I mean, for the Fed rate and the mortgage rates, they have some effects to each other, but they're not, basically directly correlated. The one thing that we look at is the 10-year bond or the 10-year treasury. When it goes up, rates, will tick up, and then when it comes down is when rates come down. There's a lot that goes into it, but essentially the bond market is what really dictates on how our rates react. So, we want to see treasuries being bought and just confidence in the economy with the 10 year. Um, you know, it's obviously the more bonds that are purchased, rates come down. And there's a lot of factors that come into it and reasons why investors purchase those bonds. Some of the things that we follow are the reports on, like today was the jobless claims report. There's the CPI, the PPI. There's the ADP jobs report, unemployment, all factor into how the rates are going to react and how investors react. So, again, obviously we don't like to say this, but the unemployment in regards to seeing rate cuts and a lower 10 year, we would like to see it on, taking up a little bit. Obviously not what we want for American citizens and things like that, but that's kind of a fact. That's a major factor. And today, like I said this morning, the jobless claims report came in lower than expected because last month it was 263,000, if I'm not mistaken.